Imagine winning 7 trades out of 10 and still struggling or even blowing up your account. That sounds unthinkable, right? And yet that's what a massive study revealed, tracking 25,000 traders over a 15-month period, analyzing a total of 43 million trades. And the conclusion was shocking. Being right often in trading does not mean having a profitable account. So today we're going to dive into this study, which is the most important one in modern trading, which shows that the majority of retail traders seem doomed, even if they win more often than they lose. We're also going to answer the following question: why does trading seem so easy in theory, but is brutally difficult in practice? And also, what can you do to avoid being just another statistic? So this is not going to be a strategy tutorial video, and we're going to see how understanding the way our brain tries to betray us is 100 times more important than trying to find a new technique to detect entry or exit signals. If you've ever found yourself stuck or frustrating in your trading journey without really understanding why, then this video could potentially change everything for you. Because actually, the biggest enemy isn't the market, it's what's going on in here. Okay, so let's talk about this study and the numbers. It was conducted by David Rodriguez, an analyst who worked at FXCM, one of the largest CFD brokers in the world, which had more than 25,000 active traders every day. And over a period of 15 months, these 25,000 traders placed a mind-blowing total of 43 million trades. That's an average of about 5 trades a day per trader. And what's super interesting about this is that after 15 months, the FXCM analytics team had access to one of the most complete and largest datasets in the history of retail trading. So what does this study reveal? Here is the twist: 62% of the trades were winners. Take a moment to let that number sink in. Basically, it means that most traders were right more often than not, and therefore they won more trades than they lost. Oh, and I mustn't forget to mention that these 43 million trades were analyzed across the 15 most traded Forex pairs. At minimum, they were right 49% of the time on the AUD-JPY pair, and at best, they were right 71% of the time on the AUD-NZD pair. But as I said, on average, out of the 43 million trades, roughly 60% of them were winners. 62% to be precise. So those are really great win rates. But here is where it hurts. Out of all these trades, in total, they lost money. How? In fact, when they lost big. We can see it visually. For almost all the pairs, the average loser in red was much larger than the average winner in terms of pips. On the Euro-USD pair, for example, which is the most traded pair and had a win rate of about 60%, we can see that the average winner brought in 65 pips, while the average losing trade lost 127 pips. Therefore, a losing trade loses twice as much as what a winning trade gained. For some other pairs, it was even worse. Look at GBP-JPY. This gap widened. Only 52 pips on average for a winning trade, while the losing trade lost around 122 pips. In other words, even though they were right pretty often, the losses were so huge that they erased all the gains. And here is a first brutal truth: it's not how often you're right that matters, it's how much you lose when you're wrong. The study by David Rodriguez and FXCM showed that many retail traders have good instincts, but very poor execution and trade management. In fact, they cut their winners way too early for fear of seeing their floating profits disappear. This study has huge implications since it reveals how the vast majority of retail traders act in the markets. And given that 90% of them lose money, from that point on, we can try to understand why and what we can do to avoid being one of them. Before continuing, tell me in the comments section if you recognize yourself in these statistics. Do you find that you're right more often than wrong, but your losses are significantly larger than your gains? If you're wondering why your strategy almost works, or why your win rate is good but your account seems to stall and never grow consistently, well, here is a possible explanation. First of all, know that you are not alone and that you are not flawed, but the default human way of trading is. Actually, write in the comment section, "I'm not flawed." Nobody will understand what it means except those who have watched the video up until here and who will know exactly what you're talking about. What you need to understand is that the root problem is not a bad strategy or bad technical analysis. The study did not highlight a flaw in the market, but it revealed a flaw in us. The raw truth is that the issue is generally not technical or analytical, but psychological. Tom Hogarth, in his book Best Loser Wins, says that the best best trader is the one who loses best. Why? Because trading, before being a battle against the market, is above all a battle against our own instincts. Think about it. When you are in a losing trade, your brain begs you to wait. Maybe the bottom is near, maybe it will bounce back soon, and maybe just a little bit more patience is needed. That little voice inside your head that tells you to wait, that's just the mechanism of hope that's trying to comfort you rather than facing the harsh truth. Conversely, when you are in a winning trade, what usually happens? You see your floating P&L and you panic because you fear that it might disappear soon. So what do? You close your position to secure the profit. And that's your fear response, your brain's reflex to protect you from potential future pain, even if that sabotages your long-term success. Do you see the common points between these two scenarios? In both cases, the brain wants to avoid pain. In the case of a losing trade, being wrong might cause pain to your ego, and in the case of a winning trade, it would be the pain of seeing the floating profits disappear. And this behavior is ingrained in all of us. In behavioral economics, this is called loss aversion, the psychological tendency to feel the pain of a loss more intensely than the pleasure of a gain. And in trading, that's clearly a poison. Among the 25,000 traders followed by FXCM, the pattern was always the same. Average trader holds on to losses for too long and cuts gains too early. Why? Simply because our brain is not designed for financial markets. It's designed for survival. But in trading, survival instincts are the worst possible guide. Our brain is built to flee lions, not to short the S&P 500. So to succeed in trading, you don't need to constantly look for a new strategy or a new indicator. You need to reprogram your brain to become what Tom Hogarth calls a rational loser. That means someone who simply knows how to accept their losses without seeking revenge and without feeling pain. And moreover, this shows that success in trading has nothing to do with intelligence, because it's the default human behavior that we all have that is harmful to success in trading. And 43 million trades made by 25,000 traders over 15 months, that's a very statistically relevant sample to draw that conclusion. So the main cause of failure for the average retail trader is not your broker hunting your stop loss before turning price around. No, it's simply our brain and its mechanisms to protect us from pain. And as a matter of fact, brokers do want retail traders to succeed, because a successful retail trader stays longer and then generates more volume. But the broker can't do anything to prevent the brain from sabotaging itself. So let's now look for a potential antidote to this vicious cycle and a change that you can make that could turn things around in your trading. No, it's the mindset that must come before method. Basically, if you're currently stuck in your trading, there's a very high chance that developing your analytical skills isn't what will bring you closer to profitability. Instead, you should focus more on having mental flexibility now that you understand what makes 90% of retail traders lose. Most retail traders are obsessed with charts. They learn about candlestick patterns, reversal structures, Fibonacci retracements, etc. Yet all of this is useless if you can't hold a winning trade or accept losing without flipping out. That's why, as Tom Hogarth said in his book, you don't need to become a better analyst. You need to become a better loser. And that's where the real hard work begins. You have to train your mind to lose well. And that is clearly not easy, because it goes against our instincts. So you have to be comfortable with your primitive instincts and know how to recognize them well. That means knowing that these instincts will try to lead you astray when you trade. And the big challenge is to act deliberately against them. And by doing that, you will realize that the more something feels unnatural, the more it's probably the right thing to do. Basically, you really need to seek control, not comfort. That means aim to execute well instead of aiming to be right. That's where the exit from the tunnel lies for 90% of the losing retail traders. So it's not a matter of tools or analytical skills. It's really a matter of mental reprogramming. Because as long as a trader doesn't change their emotional response to wins or losses, no system and no strategy will be able to save them. Now, a second potential antidote to keep your instinct from leading you astray and sabotaging your trading is automation. Basically, instead of trading manually yourself and making your own decisions and managing your trades, you let a program do it for you. Of course, that has major advantages because the program has no emotion, so it will never go offline. And that's exactly the kind of solution that Upside offers. Because even if you don't know how to properly trade, as long as you have an idea for a trading strategy, you can simply express it in plain text and do a backtest to see how it would have performed all the way up until today. And you can do this in just 2 minutes. And if the strategy doesn't work, great, you just save yourself months of potential losses and frustration. And if it does work, then you can launch it in real-time simulation to see how it will perform now in the markets. In the future, you will even be able to run it on your own portfolio to let it manage trades for you. To create such an automated strategy, all you have to do is be able to type its rules in plain text, as if you were explaining them to a friend in an email or a chat. Now, of course, automating a strategy won't do miracles if the strategy itself, even if it's automated, has no competitive edge whatsoever in the markets. In that case, you shouldn't expect to make gains just because it's automated. But if you have a good strategy, or if you think you can identify one and you want to automate it so that it never breaks your plan, then I invite you to visit upside.com. You can see the link in the description below. All right, now let's get to our conclusion. What did these 43 million trades teach us? And if I had to sum up in just one sentence why 90% of retail traders lose, it would be the following one. Because your brain is always trying to protect you from pain. Once you understand that, that's when the real work to improve in trading can begin. Now, if you like this video, please give a thumbs up, that will really help the channel, comment or subscribe. As for me, I'll see you in the next one. Bye.